All right, folks, thanks for joining today. This is being recorded. I mentioned at the beginning of every single webinar is watch it again, because some of the nuances that I'm going to be talking about will just fly by you. Second time through, you guys will have a much better grasp of what's going on here, because at the end of the day, I'm trying to get you folks to a place where options just make sense. And I've geared this course to introduce traders and investors like you to options, and I'm sure even this old floor trader can teach the savviest of traders a thing or two. And I know options can be intimidating, but I build from small concepts, simple concepts to real life examples. And by the end of all of this, you should have a solid understanding of options. And my goal is to get you folks to a place where you understand options intuitively. And I think I can do that for you quickly. So what we're doing here in this course is finding swing trades and then using options around those swing trades. Why do we do that? Well, I'm going to explain why I think that using options around swing trades is a much better choice of a directional assumption, and we'll dig into that as we go along. Ultimately, though, we're going to be talking about a synthetic long, and not a lot of people in Twitter sphere even talk about a synthetic long, and that's because they don't really know what it is. What we're doing is we're building an option strategy to perform exactly like the underlying. And what I mean by that, if you went out and bought 100 of XYZ stock, all right, this option strategy will perform exactly like XYZ stock. That means if XYZ stock goes up by $1, our position increases in value by $1. Vice versa, it goes down by $1, we are going to lose $1 to the downside. So that's why it is a synthetic long, all right? Why wouldn't you go out and just buy the stock ETF or future? Well, because we're going to be able to use a lot less capital using an option strategy than we could if we were going out there and buying the outright underlying. All right, so let's get a couple of things out of the way real quick. Ultimately, what is a swing trade is the question we need to ask ourselves. A swing trade is basically you're trying to watch an underlying in a trend. So if it's an upward trend, I got to get my pen ready, I guess. Let me get my pen out. All right. So what is a swing trade? Ultimately, a swing trade is when we're looking at an underlying trading like this. We're kind of looking at a positive trend there, right? And ultimately, we could find something that was like this, where we've got a sideways trend. Or we could look at something like this, where we've got a downward trend. So upward trend, sideways trend, and a downward trend, right? Okay, so that is what we're looking for in a swing trade. The thing with a swing trade is we are setting up a directional assumption based on the charts. Now, this trade lasts longer than a day, and that is the defining difference between a day trade and a swing trade. A day trade is inside of 1 day. You are in and out of that trade in 1 day, all right? Whether you're getting long, getting short, whatever it is, you make that trade happen intraday, all right? You're flat when you end that day, all right? A swing trade is anything that lasts longer than a day, all right? So ultimately, a day trade is intraday, a swing trade is anything outside of it. Well, and it's ultimately based up on our technical analysis, but most people consider a swing trade inside of a year. You're basing it on a short-term momentum move, all right? So we want to find how to identify the trend. When we're trying to learn the swing trade, we identify the trend. In this case, we would be looking at a bullish trend, sideways trend. Identify the trend, the overarching trend. Then we need to find the support area and a resistance area for our trend, okay? Support and resistance, okay? That's the second step. Finally, we need to find out, we've got a trend, we've got a support resistance, we need to find the pattern within the trend. In this case, we would have a bullish, this is a bullish pattern, bull pattern with a bullish trend with a bear pattern inside of that trend. We've got a sideways trend or a neutral trend here where we're trading sideways, and we have a bullish pattern within the trend. Bearish trend, a bullish pattern within the trend, okay? So when you're looking at a swing trade, obviously it's going to last longer than a day because that is a swing trade, right? But then we need to find our overall trend, those support and resistance, and then try to identify that pattern within the overarching trend, okay? So IBM, if you guys have been following along with this course, you guys know that I love this setup for a while now. It's starting to break down here, but we'll find, I got some other ones that are a little bit better. But we can see that we've got a resistance and a support here. Overall trend sideways, right? And inside that, you can look for the patterns. And to me, you know, that would have looked like the pattern was starting to roll back over, okay? So that's ultimately when we're looking at the charts, we look to find what happens in that. But we also have this happen, right? When we determine that we've got a market like this, we've got an overall higher trend, that bearish pattern within the trend. So what do? Right here, we decide to get short, and then the next day might do something like that, right? That will happen where it will kind of start to break down a little bit and maybe hit that trend channel again. And the beauty in options is we will be able to get great strike locations for these things, and that will allow ultimately you to keep your powder dry. So, you know, you get a sideways like this, and you're kind of waiting on it or whatever. It comes back down, right? Maybe hits this, looks like it's going to go back up. You get in, and it drops back down. So it's not always going to be perfect, folks. There is no option strategy out there that is perfect. There's no swing trade setup that is absolutely perfect, okay? It will have a tendency to every once in a while break down. And what we want to do is try to get ourselves into a position where we can avoid when these things go against us a little bit. If we can set ourselves up for success when we're building this strategy, then ultimately we're going to be more successful. So when we're doing a swing trade, we want to identify the trend, identify the support and resistances on that trend, and then ultimately try to figure out what the pattern is within the overall trend. Because this is ultimately where we're going to be basing our directional assumption from. Our support and resistance are going to really be the things that tell us where we need to get out of this. If it's broken out of this support and resistance, you need to get out of any type of swing trade, okay? It doesn't matter if the probabilities are in your favor. If you are setting up a trade around a swing trade, get out when that pattern is broken. And I'll talk a little bit more about that as we go along. I'm trying to sprinkle some things in here, get you guys thinking, and then we will rehash this stuff as we go along here. Now, I mentioned this a little bit. Why options? You have better odds of success, all right? When you're trading options, you will always have better odds of success because you can, even with this strategy, where I said it's dollar for dollar the same way, we can make this strategy, when we build this strategy out, there are times where we are going to be better off even doing this strategy than the outright underlying because we're using options. It will give us better odds. We might be able to buy this at a location that was not conceivable with the outright underlying, okay? Now, I know that probably blew a few people's brains away there for a second, but I'll show you how that is true and how we can build that out. So ultimately, when we're looking at a swing trade, something like this, not a very good setup right here, right? We don't have a very good pattern. Very easy to see the resistance and the support areas, the overall trend, right? All of those things. We can see patterns within the trend, but it hasn't really come down here and tested any areas to really get me excited to get involved in this. So something like that, yes, you can see it. Is this what's happening there? It got a little bit messy, so that's something you would want to stay away from. Okay. Now here we can see it does have a tendency to every once in a while break above or below the support and resistance, but I'm going to say this is resistance and we've got support here, right? We've got an overall sideways trend, and right here I tested that support, popped back up and settled above it today. Now I took this snapshot really close to the end of the day. I don't know exactly where Netflix finished out, but if I'm looking at this pattern and I'm an aggressive trader, all right, most people would wait on something like this to wait for a confirmation and get a candle where you get a confirmation. And basically, as soon as it starts trading above today's high, then that's where you're getting that confirmation for the most part, if you're a little bit less aggressive. I like to set it up on the candle usually. I will wait for confirmations, but something like this today, we'll have to keep an eye on. I didn't put this trade on today because I don't like front running you guys before I get on a webinar. I don't want to do that. I want to talk about it just as if we were all going through this together. And I'm not trying to pump and dump. So I haven't put this trade on, but it's looking really good after today. So a confirmation, that would mean that we had found the support. We have a confirmation of a pattern moving to the up. All right. So that's what we're looking for in a swing type trade. You know, if you're really aggressive, you see a candle like this at the bottom of a move right on a support and it gets above it. That is pretty darn strong for a swing trade, folks, if you don't wait for it to get confirmed. If you are waiting for it to get confirmed, then, you know, you would wait for something like this, where it's a very similar setup. We've got the candle at the bottom here, and then a confirmation candle there to the upside. So for me, Pepsi has gotten back into this area where we have the support. And when you go below a support level, folks, it's just a resistance now, all right? So we can see that we would call this normally a support, but, you know, yesterday that would have been a resistance. Today we popped above that, so now it's again support. So we've got our support, we've got our resistance, and we've got look to be what is somewhat of a sideways trend, but ultimately I've got a bullish pattern inside of this sideways trend. But I also think that we're going to start going up to look to test this area here. So 148. So I've got my target, right? I've got my out, which is right below 144. We're looking at it breaks below this little 144 area, which is this support and resistance on the Fibonacci. A break below that, I would be out of it, all right, based on today's candlestick setup. And then another thing is, you know, you on your setup candle, if I get into this tomorrow, your out would be what it gets below that low of the previous day's wick. If I had gotten in today, then, you know, my out would be below that that little setup candle is usually how you look at trading swing trades around candlesticks. So people with less risk tolerance would probably pick this line in the sand right there, all right, for their swing trade. Now, let's go over a few things real quick, just to brush over this for some people that might be new to options, getting involved in options here. We want to talk about a few definitions. The call buyer, if you are a buyer of an option, you have the right, but not the obligation. Remember that. You have the right. You don't have to. So if you are a call buyer, you have the right, but not the obligation to buy that stock at whatever strike price you have purchased. All right. So that's where if you decided I want to buy this stock, you would literally be buying the stock at the strike price that you own. All right. The seller of that call option on the other side of the trade has the obligation to deliver that stock. All right. So if you don't have the stock, then you are short the stock. You're going to have to borrow the stock to be short. Okay. So, and that's only if the call buyer decides to execute the contract, which means, you know, to say, hey, I want to buy that stock at that strike. That's the only time that will happen. And usually that will happen the closer and closer to expiration. If you are 100 days out, it is most likely nobody's going to assign you on that call. Right? And then if you are a put buyer, the buyer of the put has the right, but doesn't have to, has the right, but not the obligation to sell that stock. All right? So that means I can, if I want to, sell the stock at the strike that I own. All right? Whatever strike you own, that's where you have the right, but not the obligation to sell that stock whenever you want. The seller of the option, seller of any option, in this case, the put seller, has the obligation to deliver or to deliver that stock to the put buyer. All right, meaning I would have to sell them, or take delivery. I got ahead of myself. I was trying to think of something else. The put buyer has the right to sell the stock, not the obligation. The put buyer has to then buy that stock at that strike level. He has no say in taking delivery of that stock. Okay, the put buyer has the say so. All right. So call buyers want the underlying to go up. Put buyers want the underlying to go down, right? Call sellers want the underlying to go down, and call buyers want the underlying to go up. Put sellers want the underlying to go up. All right. First thing we need to do when we're trading any option, we need to know whether those option prices are cheap or expensive right now. All right. So we need to look over at the option montage. And in this case, I'm looking at Pepsi. And I'm going to look over here to see if they're cheap or expensive by looking at Vega. All right. We've got this little Vega over here. And Vega, where's my Vega over here? Vega's right there too. But Vega is also these numbers here along the line. This is all Vega, and it's implied volatility. All right. Basically just a fancy word for implied volatility. All of the Greeks, they just wanted to get fancy with them, all right? I've got little ways to remember them pretty easy. Vega is just volatility, folks, implied volatility. But 17 is determining, the 17% is helping determine what these pricings are over here in the option montage, all right? On all the calls and the puts. All right, all of those prices are really being determined on any given day by the volatility. All right, there is a premium involved, but what makes these fluctuate up and down is volatility. All right, usually we just talk about the erosion. These premiums will go down every single day, but how can these premiums go up in value if the underlying doesn't move? The only thing that can make them go up in value is implied volatility going up. All right, and that's Vega. But this number doesn't tell us anything other than where implied volatility for this underlying is right now. So we have to go take one more step. We have to find out what this number is, this 20, because it's a spot month. Usually, if the spot month is right around 35 days to expiration, that's where the most people are trading. So it's usually going to correlate closest to the one that is that number. So we've got about a 20 here. So we need to figure out if 20 is high or low for Pepsi. So we look at the chart, and what we do is don't even look at this part of the chart. What you need to do is look down here where I've got a new chart and it says implied volatility. All right. So I chart this. Why? Because Pepsi has volatility, but I need to know where this number is. This is the 20, all right, in relation to the low and the high. Because implied volatility tells us what the expectation of volatility is, but all of these underlines will have kind of like a swing trade opportunity in them where they will have a range. They're usually neutral. Let's say they're neutral trending because they usually have a high and a low that is pretty solid, folks. So what we try to do is determine where it currently is in relation to that high and low. All right. So are we trying to find a pattern within the trend? It's down there at that support area. We expect it to go higher. It's up there at that resistance area at the top of the band. Then we think that that is expensive, right? Because that's at the most expensive we've seen those premiums in the last 52 weeks. That's a pretty good indication those premiums are expensive. So we can even just look down here and see that if the line is near the bottom, the dot, then it is pretty low volatility for this underlying, right? So let's drill down on this. Zoom in on it, I should say. So ultimately, we can see the high is, let's just call it 30, just to round it off. I'm going to say the low here is 18. All right, and the current, let's just call it 19 and a half. Fine. Sorry, I hit the button to change it. Go back. All right. So, and the middle of the road's kind of right here. Ultimately, what we're trying to do here is we take where the current is. This is how you come up with implied volatility percent, folks. So the current implied volatility minus the low volatility, implied volatility, I should say. All right, and you take that and divide it by the sum of the high implied volatility minus the low implied volatility. So really, you can start to see that we're trying to figure out where the current is in relation to the high and the low range, right? So we've got the low and the high here range. And so we take the current, which is 19 and a half minus 18, take that sum and divide it by the 30 minus the 18 and 18, right? So we got what, 1.5 divided by 12, and that's going to or 1.5 minus 20, 12. 1.5 divided by 12 is going to be what, around 9%-ish? 7%? Anybody got that number? Forgot to calculate it beforehand, so I'm going to do it here. 1.5, unless somebody else gets first. 1.5 divided by 12. So, 12.5%. So 12.5% is pretty low. So usually I say if it's greater than 50%, you're going to sell, or you're going to buy. If it's less than 50%, you're going to buy. Buy. Okay, all right. Less than 50%, you're going to buy. If it's greater than 50%, you're going to sell. All right. But look what's happening here. I'm saying you should buy, but what if volatility continues to go down here? If volatility continues to go down here, my premiums are going to continue to go down as well, right? Because I said if volatility comes out, those premiums will come out also. So not only are we going to have to fight against a directional move, but we could see volatility come out in this underlying if it continues to, or we could see our premiums go down in value if our volatility continues to come out. So that could be a concern with this. All right. I expect this to go higher just because, anytime it's at these extreme lows, I know they're pretty cheap. But what happens if we start going back to like 2019 volatility, right? Where the VIX 20 is, the new teens I've been saying is the VIX 20. Well, what if it goes back down to those teens for the VIX and all implied volatilities start really going down? It's a concern we're going to have to worry about. So let's just say with this underlying, I'm a little worried about that. Yes, and this can go for any of your assumptions, right? You're going through this option montage, or maybe the underlying is right here, right in the middle, and you don't know if it's, up at this 50% or if it's at this 50, or, it's right at 50%. It's right on the number. It's 50-50. Well, that would be another case where you're starting to think, I don't know if volatility is going to go higher or lower, and I'm worried about the volatility going down. So those are going to be things that you would have to consider with this strategy, all right, or when you're trading options. And in this case, I'm going to go with the feeling that I am worried about volatility to continue to come out. Yes, it is extremely low, but I'm worried about volatility really coming out. So I've determined that the option prices are cheap, right? But I'm worried about them getting cheaper in this case with this underlying. So is there an opportunity where I'm going to need to look at a hedge for those pricing? And how do you do that? How can you offset the thief in the night that we talked about, right? Because the closer we get to expiration, we can see the thief in the night really starts eating away at our premium. So in a case where I am looking at low volatility, thinking about buying an option or something like that, well, you know, we're talking about getting out here where theta isn't as aggressive. You know, this, like I've said, you sell out here, right? Or sorry, why am I'm dyslexic today or something. You buy out here and you sell inside of here, okay? Because when you sell, you want the prices to go down, and when you buy, you want to hold on to those premiums, all right? That would be your first thought when we're looking at theta. Now, what happens if I want to, you know, get out in time, but maybe I want to eliminate theta? Is there a way to eliminate theta? Is there a way to eliminate volatility in this option contract or in this option strategy or any option strategy? That would be the question. You know, all right, I'm a little bit worried about theta. I'm more concerned about where volatility is going. I don't know if it's going to go up or down. Yeah, Jeff's kind of on it. He's on it. You can isolate it in a couple of different ones. You're right. In the next couple of webinars, we are going to be talking about how you can isolate volatility in theta. So how do you offset theta? Well, if you are in the same option contract, you can see that the calls, we're looking at theta here and theta here. We can see that the corresponding, here's our strike, right? For the puts and the calls, we've got our strike right here. So if you look at the same strike for the puts going that way and the calls going this way, you will see that these theta coefficients are the same, right? They're both negative. Why? Because theta is going to continuously come and take your money, all right? So all of the Greeks are assuming a move forward of 1. So delta is $1 higher. Theta is, let's forget about theta right now, or sorry, gamma right now. Theta is 1 day goes by, and vega is an increase in the number by 1 percentage point. So everything's an increase of 1. And when tomorrow comes in, one is the puts are going to lose 6 cents, and the calls are going to lose 6 cents, right? But we can offset them. Think about it. If I buy a call, this theta is negative to me, right? Because I am long an option. Tomorrow I wake up, it's going to be worth 6 cents less. Now, how can I offset that? Well, if I sell a put, right? If I sell a put, a negative plus a negative theta is a positive to my position. If I sell a put and I wake up tomorrow and it's 6 cents less, then that helps me, right? I sold it higher than where it currently is. So if I buy a call and sell the same put, that theta will offset one another. Because one is a negative to my position, my long call is going to go down in value from that long position because of theta, but I sold a put and I benefit from that theta when I can sell it high and buy low, okay? So they're offsetting. So that we've taken care of. Theta we don't have to worry about. One thing I would say is, if I can offset theta and don't have to worry about it, do I really want to be 15 days? No, I want to go out in time. Anywhere out there in time. Now, usually for me, swing trades folks aren't going to last longer than 2-3 months, all right, on a technical setup. It just doesn't usually happen. So that's why I usually like to pick this, 71 days. You can go out 100 days if you are looking at a longer term trend. You're a longer term trader. Then yes, you can go out 300 and some odd days, all right, and do this strategy.
You're not going to have to put up that much more money for that longer duration than the one that's in 70 days. It's just, I prefer the options closer like this inside of these, just because the markets are usually a little bit better. Now I'm going to show you a little trick to be able to implement this strategy in really wide markets. I'll show you how to narrow down and figure out how to price this when the markets are really wide and you're just looking at it like, I would never know where to buy or sell these options. I'm going to dumb it down for you really easy for especially some of you newer traders so you can spot it quickly. So we've determined we're going to go out in time, especially if I can eliminate theta. I might as well go out in time. Give myself more time to be right. So, I don't know why I pulled up this one, other than we're looking at a chart. We've got a bottom here. I've got a confirmation. I think the pattern inside of this little sideways trend that we've got going right now is bullish. I'm going to look for it to go up and test the high on the Fibonacci, all right? So I'm looking for a bullish move here. I'm worried about volatility coming out because another thing we know about volatility, folks, is usually when the underlying moves higher, volatility comes out. Now, I've talked about this time and time again ever since I've been a trader. That's not always the case. FOMO, fear of missing out on the upside, is real. And it's even more real in today's day and age with Reddit traders. I don't know if they're Reddit traders or whatever, but that's what everybody calls it. The newer generation of traders is trading options more so than the last generation. Let's call it that way. And they love going in and buying calls on a bullish move, all right? So, because they've learned that they can limit their margin. They can leverage a little bit better. So, with that being said, we want to play this to the upside. I don't know where my, I was going somewhere with that. And based on this technical setup, all right, move to the upside. What I'm looking at. All right, so if I want to hedge that theta, the thief, and the volatility, right, then I want to do the synthetic long because let's go over delta real quick. Delta is the rate of change to an option premium. Okay, now usually we talk about this and I say we don't really have to worry about that. Well, we're going to talk about it a little bit today with this one, but usually I talk about delta is data, all right? And what that means is delta, the data or the delta tells us our odds, all right? Because when we look at probability, when we look at the chart of a standard deviation curve, ultimately what we're looking at is right here, 0. That means unchanged for when you're entering this strategy, okay? Whatever price you are at in the current underlying is really where 0 is, because at any given moment, the idea is 50% or 50% of the time it'll go up, 50% of the time it'll go down from that given point, all right? So that means if we look at this as being the calls and this as being the puts or the downside, and we're currently right here, that means if you add up all of these, that comes out to 50%. If you add up all of these to the downside, that comes up with 50%, all right? Now, you can see that these are all negative. And standard deviations line up with probabilities, right? So what we could say is, right here, if you added up all of these going out the curve here, we could say that this is right around 32 delta. This is right around a 16% probability, 32% probability here. This one's going to be about 6-7% probability. All right. So, and the same goes here, 32% probability, 16%, right? Well, this also in the options is the same as delta, all right? So delta is our probabilities. So when we're looking at an option montage, and for instance, we can go back to the option. I'll talk about it here in a second. But ultimately, the probabilities on this bell curve, that's how we came up with deltas, because that's the probability of something happening. Now, yes, it does. You know, if this XYZ goes up by $1, the definition says our premiums are going to go up by that corresponding amount. Let's just take a look at this. Well, we've got a 50 delta, right? It means if this underlying increases by $1, this is going to increase by 50 cents. Okay. If the underlying increases by $1, these premiums are going to decrease by 50 cents because you can see it's got a negative in there, right? And what did we say? Delta tells us probabilities. Well, it's a 50-50 chance of going either way. Right now, when the underlying is trading at 145, 41, well, that's really close to 145, right, that we're talking about with the strike. So it's basically saying a 50-50 chance of it going in either direction at any given time. All right. That's one of the things that deltas will tell us. And the premiums, we already got that, right? Well, if I buy like this call here and I sell this put here, right, we can see, we talked about theta. We can see that the theta coefficient right here, and I'll draw a line straight down to the theta coefficient here. Yeah, it's off by a penny. It's showing it's off by a penny right here. Well, that's probably a rounding error, guys. It's going to be so close to it that it's not going to really affect us that much. Volatility, the Vega coefficient. Look, 26 here, 26 here, right? So again, I'm long a call here. If this increases, if volatility increases, my premiums increase by 20 cents. But if the premiums increase over here by 26 cents, right, that hurts me. This one would help me, right? I'm long, premiums increase. That helps me. It hurts me on the other side. So they're offsetting, right? So if volatility moves, it's not going to affect my strategy, okay? So ultimately, we are looking to create a synthetic long by buying it at the money as close to a 50 delta as we can, and then we're going to short an out of the money negative 50 deltas, right? So we buy 50 deltas and we sell negative 50 deltas, right? Two negatives make this a positive. So that you add those together and you get 100 deltas. Does that make sense? Should I go over that again real quick? If you buy 50 deltas, right, and the underlying goes up, then my position increases by 50 cents, right? If I sell 50 deltas in the put side, those are negatives, so two negatives make it a positive. So if I bought a call and sold a put, right, that would equal 100 deltas. What did delta tell us? That it will move in relation to the underlying, right? So if I am long 100 deltas and the underlying goes up by 1, well, my strategy goes up by 1, right? You know, because they're 0.50 deltas or whatever. Okay, so 50 deltas is a 1. And, you know, I always round it up to that 50 and 50 and 100, right? That's because it's times 100, right? That's the option contract multiplier. And that's because every option is equivalent to 100 of the underlying. Think about it. When you go out and buy a stock, the assumption is you're buying at least a quantity of 100 and then therefore multiples of 100 going forward. So they've made the option contracts in order to hedge stock, right? So every option contract is equivalent to 100 of that underlying. And when we build it out this way, we are making it 100 deltas. And another thing I want you to notice here, when I said that if you are getting involved in this with an underlying where they usually have wider markets, or we're getting out there in time where there's not really a whole lot of participation, volume, and open interest, there are not a lot of eyeballs in there. How do you know if you are pricing this correctly? If you are doing that, what you have to do here is put take your call on your put. You're at 145, right? 145, and I got a credit here. So basically, it's a negative credit, which means it's actually a debit. So 145 plus 55, that means I'm buying this at 145.55, right? That's where my break even is, in a sense. So that's where I'm synthetically getting long this underlying. Now you can see it's slightly more than where it's currently trading. Generally speaking, when I'm building this strategy out, I will be able to buy it below where the underlying is trading. And probably if you go back and watch any of my past webinars on a synthetic long, I've been able to build this out for less than where it currently is trading. That's the beauty in using options. And that's what I was saying when you're using options. Sometimes you have less risk, or you could buy this at a place where it's not otherwise conceivably possible. I could end up buying an underlying below where it ever traded during that day. Okay, does that make sense? Because I build it out. If I add that in, I'm getting in below. All right. So that's, if it's really wide, just know that what you're paying, a credit or a debit, you know, that with your strikes is where your break even is. If it's a debit, it's higher. If it's a credit, it's below. Right? And in this case, it was a negative credit. So that's what makes it look a little bit wanky. Another one that I wanted to look at, because we were flipping through and Netflix had a nice little setup as well, is we can look at this with Netflix also. And again, here we have a positive 52 deltas, over here a negative 48 deltas, right? So you can see where 52 plus a negative 48, right, that I'm selling, that adds up to 100 positive deltas. All right. So you can set, oh, and this is what I wanted with this. Like, how many people have enough money to go out there and buy 100 Netflix in their portfolio? Not a whole lot. I mean, that's, if you bought it outright and didn't have margin, that cost you $50,000, right? Or very close to it. If you're doing it on margin, that's going to cost you close to $25,000 for 100 of these. If you're doing this with options, it's even half of that. It's about $12,500. So, you know, if you're trading on margin, this is an option strategy using a synthetic long will cost you 50% less than going out there and buying a stock on margin. And they will perform exactly the same. This underlying from the point of inception goes up by $1. My strategy will increase by $1. Right? Because if it goes up by $1, these increase by 52 cents. And if it goes up by $1, these go down by 48 cents. I'm long this one and I'm short this one. Right? One goes up, the other one goes down. Perfect scenario for me. And it will change on 100 deltas. Ultimately, this is the Analyze tab. If I set up the Pepsi trade, right, we can see that it is running lockstep with where the underlying is trading, dollar for dollar. It'll get a little bit off the further and further this, you know, if your long call goes way in the money, you know, the puts and the calls, it's not going to be exactly 100 deltas every single time, okay? And one of the downsides to a synthetic long is, folks, you are not going to get a dividend, all right? You're not going to get a dividend. But keep in mind, you're going to have to put up half as much margin as you would if you bought the stock outright, right? So, you know, smaller accounts can actually create a better or a more diversified portfolio using options. Yes, they are going to expire and you don't get paid a dividend. Those are the downstrokes. What you have to think about is, though, listen, I put up, you know, 25% or 50% of what I would have had to otherwise just buying the stock. You know, it's 25% of what you would have had to if you had to put a full margin, and 50% of what you would have had to put up if you only traded on margin. Trying not to make that a confusing sentence, a little bit more difficult. So we can set up both of those. You want to set it up? Let's review a little bit. We want to, in this case, we have a bullish assumption. You know, and let's just say with this bullish assumption, it's like one of those perfect setups. There's never a perfect setup, but you're looking at it like, hey, you know, it's bounced. I gave you two pretty darn good examples of swing trades that are pretty as close to perfect as you can get. Yes, they can break down. So that's always a possibility. But those were two good ones. And so I've got a bullish assumption. I'm worried about how volatility will play into this. If volatility goes up and I bought a long call, that would help, right? But if volatility goes down and I bought that long call, that volatility coming out can offset the entire directional move of the underlying, right? When we go back to this, look at this coefficient for volatility. It's 26 cents, right? The delta is, 50 on this. But think about this. If volatility adjusted by 2 percentage points, that's 50 cents, right? If this moved 2 percentage points, 2 times this 26 cents, that's 50 cents. So that is a major adjustment. 50 cents, that's 10% of that premium, right? So that's something that is a major concern that some people will need to look at. Well, I see you. I forgot the first time. Let me get this thought out real quick. So we really need to be worried about volatility. If volatility is going to come out with a long call, that's going to hurt. So that's something I want to offset. The other thing is I want to offset theta with that. I don't want to have to deal with that. I want to get out in time and not worry about that. I want this to perform just like the underlying, right? So all of those things that come together lead us to creating this synthetic long that we talked about, right? Now, when do you get out? If I'm setting up, like I said, if I'm getting set up with a strategy that has, of course, I've got the red candle here, but if I've got set up with a strategy where I found a bottoming pattern, you've obviously seen the market sell off. You find the bottom like we found, right? And even if I get a little bit of confirmation to the upside the next day, which is what I would be looking for on a trade like this, the next day you come in and boom, you get this move to the upside. Now that is a confirmation, right? That's when we get in. But what happens if like the next day, where do you get out of this trade? If you have a lower risk tolerance, then I would say you're looking to get out right here. If you got in on this day, you're looking to get out. If this was the day you got in and you have a lower risk tolerance, then right there is where you're looking to get out. People with higher risk tolerance are going to look for that line, okay? So you got the setup, boom. You have to understand yourself and whether or not you have a higher or lower risk tolerance with something like this. For me, I'm probably looking for that break. All right, so you are bullish on this trade and you use the short put to offset the implied volatility and theta of the long call. Yes. The short put wills onto this. A short put is bullish, right? Because I am willing to, right, to buy that underlying at that level, right? So if you sell a put, you actually, if it goes higher, you're good. That premium will dwindle, right? And if you're long the call, that's going to increase in value. I think I said that right. I was trying to say what I was saying there. So did I say that right? I'm trying to rewind what I said in my head. So we can offset it. If you're long a call, theta is negative. But if I'm short a put, that theta will help me, right? And the volatility will offset because the one I'm long will adjust by that volatility, and my put will also adjust by that volatility. Those will help me. Did I say it right the second time? I think I'm trying to answer the next question too. All right, so why does it say a negative 50-cent credit on this trade? Well, sometimes it does that. I don't know why it does. It's kind of annoying. But it's green also, so that's like a debit, right? So it's bizarre. Sometimes it does that. So get out on the breakdown on the setup. That's your exit on a loss, right? Your break even is going to be exactly where you got into this trade. JQ, buy low, sell high. That's right. So it would be a debit, yes, on that one. Sometimes it gets a little wanky. All right. There's no more questions, you guys. This is our offer, and we are down to less than, I think it's, we're in the teens on how many people we're going to accept. And the reason why, folks, is because it does get overwhelming for me. And so I just have to limit it. That's all I can really say. You guys get access to all of the Option Labs courses, you guys. And we might be saying, hey, we're almost out of options or out of earnings, I'm sorry. But we are doing setups for the next one, all right? So we can set up earnings trades for the next round using these options. And I'll show you how to do that in this course here. Also, the best way to set up trades around that earnings. It's not going out there and doing the Goldman Sachs just buying calls. I completely disagree with that. I think that you'll get run over if you follow those guys doing that. So I'll show you the right way to trade that we used to do it on the floor, and I'll show you how to spot those trades quickly and easily before you get involved. So please take a moment to check this out. Like I said, here is the link. I'm throwing it over there in the chat window right now for you. If you want to click on that hot link, it'll take you right to this page. And finally, I just want to say thank you guys all for participating in this webinar. Future webinars, I'll drill down on different option components when and where I find those appropriate. If you have any questions, comments, or ideas for future webinars, reach out to us at trading@protraderstrategies.com. All right, that's all I got for you guys. I hope you guys check this out. If you're worried about the downside, if you're always trading a strategy around a long stock position, right, and you're always using a stop, you could do a long put, add a long put to this right around that 16 delta is where I would usually go for it. Just know that when you are adding security, you're limiting your risk, right? You're also limiting your reward. And in this case, if you buy that put, all that does is it makes your break even go above where the underlying is trading right now, right? When we build this strategy out, we're going to be able to buy this underlying at or below where it's currently trading. And if you add that put into it, you're going to be buying this a little bit higher, okay? So yes, you will be limiting your risk to the downside, but you're going to make it a little bit harder for you on the upside. And finally, please take a moment to go over this disclaimer. Folks, we're an educational company. I'm not trying to get you guys to jump on a synthetic long in Pepsi tomorrow, all right? I'm trying to use real life examples to show you guys when you come up with an assumption on a directional move, how you can set up a trade like this. If your thought process is like this and you're thinking, I want dollar for dollar, this is a great setup, all of those things. I want to limit theta, I want to limit volatility because I'm not really sure where it's going to go, then this is probably the best strategy for that type of thesis. All right? All right. That's all I got for you folks. Hope you guys enjoyed this webinar. Please smash that like button for me. It helps out. It really does. If you have any questions, comments, I'll be happy to go back and forth with you down in the questions box down there below or the comments section. I'll make sure everybody's clear of concept. All right, that's it. Other than, if you can't take that, take it easy. Have a good weekend, guys. Take care.